I am Abhiroop. I am the founder and CEO of Velocity. And on this panel, we have Noopur, who is the CEO of NPCI's Bharat BillPay. We have Inderjit, who is the CEO of Unity Small Finance Bank. We have Ram, who is the CEO of Vayana, and we have Sashank, who is the co-founder of Axio. To start with, what I wanted to do, guys, was that it will be helpful if you can briefly introduce yourself and also talk about one thing which you believe matters the most when it comes to lending in 2024. That will create an array of topics for us to talk about, and then we'll dive into it.
Sure. I guess I'll begin. Once again, Noopur, I joined NPCI to lead the subsidiary NBPL roughly around 2 years back. Before that, I've been in banking, and specifically in banking, I've seen lending very closely across multiple stints. For me, I guess what matters most in lending is how to get the money back or collections.
Yeah.
So let me leave at that, and happy to hear from others.
Thank you. Thank you, Noopur. I'm Inderjit. I head India's youngest bank. I head Unity Small Finance Bank. We got a license just 2 years ago. We are a set of bankers with a great streak of digital fintech in our blood. I have called upon those years back when I graduated from IIT Delhi to come to my aid to help me forge a bank which will truly be digital in India. Thank you.
Thank you, Inderjit.
Hi everyone, I'm Sashank and great to be here. I'm the co-founder of Axio. We are a consumer finance focused fintech NBFC which serves customers across their life cycle from checkout finance to personal loans, personal finance management, etc. I think, this is 2024 for digital lending is the year of risk. The right answer is every year should be the year of risk. But I think one of the good things is that there is a greater degree of consciousness in the ecosystem around topics of risk, whether it's credit risk, operational risk, compliance, and look forward to speaking more about this.
Terrific. Thank you.
Hi, I'm Iyer. I'm the founder and CEO of Vayana. We focus on B2B trade finance, both on the supply side and the distribution side. We also kind of function on the compliance side, where we are the largest GSP in this country. And we also do a lot of credit assessment, enablement for corporates through our platform called Rubix. I think lending is, risk collections. But I think this year, at least from the high interest rates perspective, I think what we are seeing in the market is also need to get more and more affordable, especially on the small business side. So I think that's really something I would like to talk about today.
Great to hear that. I think we have a good bunch of topics that will make up the most of this session in terms of collections, in terms of risk management, in terms of building a digital first bank. I think exciting topics. At least from my point of view, the only topic that I would want to add to this is that I believe that India is at a fairly unique juncture where the access to credit is still quite low. And at the same time, there is like a lot of online payments and online data which is getting generated. So that's a theme that I am particularly excited about, that how can the digitization as a trend be used to improve access to credit in general, right? I think that's a big theme that we are very passionate about at Velocity. So with that context, I think what I wanted to do was to like dive into a few of these topics that we discussed. I would love to keep this only loosely structured and interactive. So if you have points of view on like each other's comments, feel free. But to start with, I think the topic that every business cares about is being customer first, right? So customer centricity is the core of every successful business. And I think lending is no different in that respect. That you have to keep the customer first, you have to understand their needs and preferences. And I think I would like to get the thoughts going from you, Ram, if you can talk from the point of view of Vayana about how you are thinking about customer centricity as a priority in 2024.
So we, I think, have a little unique problem. We have 3 customers in every transaction. We have obviously the lenders, the banks, or the NBFCs. We have the corporate who wants to kind of get his supply chain financed, and we have the small business that is getting financed for either receiving money early or paying late. They are, counterparties. And I think what we really figured out is that the real customer that we need to really get consumed by is the small business. India is a very large population of small businesses. I think, while there's no reliable census, I think everybody likes this number called 60 or 65 million. And I think if you look at that entire lot, only about 12 million have unique PAN numbers in GST. So there's a very large variety of about, I think, 40, 45 million, which is outside the purview of most information flow. And I think the key thing really is but they're all part of supply chain, right? I mean, if you go to your nearby Kirana store, everybody loves Kirana stores, there'll be a lot of unbranded small little items that have all been sourced hyper-locally. That's also B2B trade. So the key thing really for me is that as I look at the customer side, I have to figure out how do I get access to credit for him. But access to credit, Abhiroop to kind of talk about, is in India, I don't think on the SME B2B trade side, access to credit is a problem. We do about $120 billion of trade every month. That won't be happening if there is no credit. Yeah. The fact of the matter is that there is no access to affordable credit. And most of these businesses operate at less than 2%. So our focus really is to kind of figure out whether the interest cost can be less than 1% a month. And that's, I think, the challenge that we see in the market. And when we talk to customers, I think while digital lending, AI, a bunch of things, obviously we all love to talk about coming from the industry, to the customer, like the old, two-wheeler hats used to go, kitna deta hai or kitna takka hai. I mean, that's all that matters. And you really have to make that aligned to the net margins of the business. So that's what we really see as being customer-centric. And I think India, most businesses, including ours, we really have to be focused on cost engineering. Instead of focusing on just volumes or market, we have to actually figure out how can we become cheaper and cheaper to our customers every year. Yeah. And I think that's really the challenge that we work on. And when we talk about customer centricity, it is about two things. One is being invisible, because the last thing you want to do is to say that, look, I am making credit easier, but now you have to come to me, which means that they have to come to Vayana and do some stuff, which for a small business really is already a pain. They already do too many things. So they really have to kind of not see me. And second is that I have to give them credit that is really cheap and being really available. So both embedded, I guess, is obviously very, very important, API-based or embedded or at source, so they don't have to interact with us. And second is to make sure that the cost of credit to them every year goes down as much as we can get them to go down. So I think that's the two things that we look at as customer-centric from our side.
Both are absolutely great points, I think, because you talked about cost, and I've also realized it in my business as well that people, particularly SMBs, care a lot about cost. And I think eventually any credit decision will reduce to a cost negotiation. And at the same time, as you mentioned, that embedding also matters a lot because they don't really want to go beyond their day-to-day environment. And if you are natively enabling credit on top of that, that's really a big theme to definitely go after. In the consumer context, Sashank, wanted to also get your points of view on that. That as you think about customer centricity, is it factors beyond cost and being invisible in your experience?
So, Abhiroop, I think in the first 5 to 10 years of fintech in India, there was a lot of focus on customer journeys. Yeah. Right? How do you improve the customer experience of applying for credit? And I think to give credit to the industry, we've come a long way. Yeah. Right? I think most journeys today are quite optimized. And the process of applying for a loan digitally is completely, I think, a paradigm shift better than what it used to be. Right? Today, we're able to onboard a customer in a couple of seconds and add about 2 lakh customers a month. Right? Yeah. I think now the interesting challenge is to go beyond customer onboarding to customer lifecycle management and building a relationship with customers. Yeah. Because the reality is, the vast majority of customers that we as an industry are acquiring are either new to credit or relatively new to credit. Yeah. Right? And so now what we're thinking about, right, we have about 9 million odd customers, is how do we deepen this partnership? How do we think about other products that they may need in their lifetime? Right? How do we think about helping them climb the credit ladder and start low but grow over time and unlock larger credit products when they need a car, a home, healthcare, education, etc., etc. How do you go beyond credit and offer tools around saving as well? And I think this idea of going from efficient acquisition to building customer LTV is a very important mindset shift that us and the entire industry is going to, and I think that's very exciting. Yeah. Because at that point, we're actually thinking about being able to be a true financial partner to customers rather than just an efficient credit provider.
well said, I think, Sashank, because I think the phase one of lending startups in India was primarily about acquisition, where they were solving for a really seamless customer onboarding and journey. But phase two is definitely going to be about ensuring that people retain with you, ensuring that you're able to cross-sell multiple products and thereby increase the LTV. So I think that's definitely a trend that is bound to play out. Now, talking beyond customer experience, right? I think customer experience, to get started, you will solve for it at a lower scale. But to deliver that really at scale will require technological intervention. It's important to sort of build technology and platforms which deliver a high quality customer experience at scale, right? I think what has also changed in the last decade is that expectations of customers are at a different level. 20 years back, people were perfectly comfortable with branch banking, let's say. But now, increasingly, they don't want to visit the branches. They want to transact online. They want convenience, transparency in everything that they're doing. So with that kind of a reality, I would love to get your thoughts, Inderjit, in terms of how you are planning to leverage that while building a digital first bank in the country, right?
Thanks, Abhiroop. Actually, Reserve Bank did think this through about 7 years back when they came out with differentiated licenses. They licensed 11 small finance banks. Small finance banks lend to MSMEs, SMEs, vis-a-vis the large corporates. Experiment has fairly been successful. We 11 banks have put together 25 million customers. If you take an average household size of 4 in India, that's 100 million people whose lives we touch. With 1,400 million as Indian population, small finance banks touch 7% of India's population already. So essentially, the plan is to reach much further than the metros into tier 2, tier 3, with products which, exactly as Ram has said, are priced right, as Sashank has said, delivered with a fast and efficient journey, but at the same time, the quality of asset, as I'm quite certain is going to come up, it has to be also bona fide. Abhiroop, this year will be a landmark year for lending in India through fintechs. I'm sure this has been said before. I think every generation thinks their generation is landmark. But this year, what Reserve Bank has put out for us is the quality of lending we do. There's something called risk-weighted asset, RWA. If you lend for certain purposes, it's low, and if you do not lend for those purposes, it is high. For example, in the microfinance sector, if you lend for consumption loans, the RWA is 125%. But if you lend for non-consumption loans, it's only 75%. So it will differentiate the price of delivery and will also demand on the RE, the regulated entity, to provide more capital. I think there's going to be a shakeout in the industry this year. We are all on the verge of it. We can see it, writings on the wall, that we will lend and grow well in India, but it will have to be very well thought through for what purposes we are lending, how we are monitoring, and how efficiently we are collecting. So I'm sure as the conversation builds, we'll delve deeper into these points.
So it's actually a good point to dive into and get more thoughts across the panel. That this entire regulatory changes which have come in, especially around the risk weights, like you mentioned, right? I'd love to hear more thoughts, particularly from the regulated entities, which is basically you, Sashank, and also you, Inderjit, further, in terms of how that has impacted your business and your priorities for the coming year.
Sure, I'll lead and tell you how. The first thing is at the customer end. Earlier we would lend if the credit could be sustained, sufficient FOIR, KYC, the customer, etc. But now we want to know what are you going to be using the money for. There is a sense by the regulators that pure consumption lending may not be the right way to go. Consumption lending could get us into a debt trap which the Western world has already faced. They're trying their best to guide us into useful, productive lending. Therefore, there's a lot of higher scrutiny on credit cards, unsecured loans, and loans for general purpose. So this year, Abhiroop, we will have to go and peel the onion one more layer And it's a very expensive peeling. When I say we have 25 million customers, just approaching each one to ask them, what are you going to use the money for? Is not a easy and a small task. So that is going to be the method which we will see this year. There will be consolidation. Fintechs and banks will ally better, will become greater friends to deliver to the market. India's solution to lending has to be a combination of fintech and banks together.
Thank you, Inderjit. It would be pretty helpful to get your reactions on that.
Sure. And look, I think just to take a step back, right? We need expansion in retail credit, right? I think we aspire to be a 5 trillion plus economy. No economy in the history of the world has grown at 8% GDP growth without a 2x concurrent expansion in retail credit. That has to happen. At 8% GDP growth, add another 6% for inflation, double that, 20% plus growth in retail lending is what we need actually as a country. I think what the regulator is saying is there needs to be guardrails for that growth, right? Because what we've seen in other developed economies, to Inderjit's point, is while that growth has unlocked a huge amount of wealth creation and job creation, there have also been accidents along the way. And our regulator, right, is perhaps more cautious, which has also led to probably the lowest rate of bank failures in India compared to any other developed economy.
Absolutely.
Right? So it comes down to not a question about whether we should grow or not, we have to. It comes down to a question of how do we grow responsibly. And I think what the RWA change is essentially doing is pushing originators and buyers of risk to just think more deeply about the kind of risk they're originating and what is the optimal rate of growth, right? I think we all intuitively understand that an unsecured business can be hugely profitable and deliver impact to customers. But if you grow above a certain rate of growth, accidents happen. And those accidents can take years to unwind. And so I think the regulator is effectively coming in and saying, look, let's be thoughtful about how fast, what is the right rate of pace of growth for this space? What is the right level of rigor and depth in underwriting? What guardrails every institution needs to put in place from an underwriting, capital, liquidity perspective to ensure that accidents don't happen like they have in the past with the IL&FS crisis, etc. And encouraging all of us as an industry to grow responsibly, right? Now, sometimes we tend to have a knee-jerk reaction and interpret things in extreme ways. But I think, honestly, it is almost a given that given the pace of growth in this sector and given how technology accelerates this growth, we need to be thoughtful, we need to be conservative, and we need to be cautious in how we shape this growth as well.
Now, please go for it, Noopur.
Just adding on to your point, Sashank and Inderjit, I think rightfully so, we look at things from the organization perspective that the regulator does not want accidents, they don't want fintech or banks to fail, so on and so forth. But having worked with them closely for the last few years, I think equally importantly, the regulator is also looking at the customers or the end consumer's interest. We're talking about a very, very young population, which hasn't necessarily seen the financial discipline that our parents and therefore we have seen. They're young kids who want instant gratification. They don't want to think very long into the future, but want that iPhone today. It is important that we, through these roundabout means, also ensure that the consumers do not over-leverage themselves, because they might do it in their first job, but it will hurt them when they go late in the life cycle for home loan, so as to say. So through these RWA measures, I'm sure the regulator is not only looking at our interests, but is equally concerned and aware about the credit history that may get created on account of over-leveraging of that consumer.
Absolutely, well said, Noopur.
I think there are 2 points that I just want to add, and I'm talking only from a small business perspective, not too much experience on the consumer side, is that our experience, at least on the field, has been that a lot of the population of small businesses, and when I say small, they could be small, micro, nano, they are not credit ready yet. And I think that's a point that's often missed in this whole aspect about, I think, a bunch of credit products that are out there, is that a lot of them don't understand the obligations of credit. And they look at credit as an easy way, as you said, Noopur, very clearly, instant gratification, or they're looking at it as immediate need. A lot of them are really not very good about managing their cash flows, understanding how to kind of save and how to kind of then use that money whenever there's a rainy day. So I think a lot of work that will need to get done, and I don't think that's really the work of the regulator as much as of the entire industry, and maybe a lot of bodies that I know Sashank definitely has been part of one of those main ones, is to try and see whether we can actually educate some of the smaller businesses and on the consumer side, maybe some of the more tier 3, tier 4 customers as to what does credit actually mean. One of the terms that I'm very scared about, and a lot of people call me very cynical, old-fashioned for it, is frictionless credit. Because credit is an obligation. I don't want it to be frictionless. I want you to know what you're taking on. I don't mind your onboarding process being frictionless, but I definitely want credit to be frictionless. I would like you to sign 25 pages of a document so that at least there's a lot of work involved. So I think one of the things that we really have to think about in this governance principle that we're talking about here on the regulatory side is that as an industry, as we try to grow and we look at blue sky and look at the untapped population and look at white spaces, we have to be also careful that the people who are buying our products, do they understand what they're getting into? Because credit is a very expensive proposition. It's a lot of obligation. And I think that's really one area that I would like to see, not the regulator, but I think the rest of the industry, banks, NBFCs, and all the REs and fintechs get a lot more involved with.
Great.
Share a slightly contrarian view. I completely agree with the views of my fellow panelists, right? I think having the right controls on transparency, mis-selling, etc. from originators is important. I also think we cannot run amok in terms of over-leveraging the broader population. At the same time, we live in a highly, highly underpenetrated country.
Yeah.
Right? And I think we tend to underestimate the level of savviness of the population. Right? Because the reality is, if we are not there, someone else is delivering credit today.
Yeah.
And the average small business owner is having to manage with a much higher cost of credit in the informal market.
Correct.
And is still managing to run their business and manage their lives despite that high cost. And I think even if you look at asset quality matrices, very rarely have we seen the financial system in India in the last 20 years be put at risk because of the small borrower.
Yeah.
Right? The entities that actually have done that are large corporates.
Correct.
Right? Who ought to have the best ability to absorb and manage credit.
Yeah.
Right? So I think building credit responsibly, delivering it carefully, thoughtfully is super important. But I also think that if you look globally, and we see this with some of our fintech peers, the default rates for more retail lending in other countries is actually far higher than India.
Yeah.
Right? And I think we actually have a population and that is over the years learned to manage credit and actually unfortunately has had to pay very high costs of it in the informal sector. And so to come back to Ram's point on cost, I think one of the things that's incumbent on us as an industry, and Inderjit made this point too, is how do you consistently lower the cost of credit so you can in some ways displace informal credit and move more borrowers to the formal system that is safer and more transparent.
Absolutely. So, see, against this backdrop of the regulatory environment that we just talked about, right, it would be helpful to get more thoughts from the panel on the roles that they see playing out between fintechs and regulated entities. I think that's a top of the mind questions for a lot of founders out there, that do all fintechs eventually have to become a regulated entity, or are there like roles for fintechs to play while going towards that bigger opportunity of enabling access to credit?
Let me try and take this one, Abhiroop.
Yeah.
I think fintechs and banks have a very symbiotic role. Fintechs by definition are more agile. Fintechs by definition are more intelligent. Fintechs have the ability to react to market, penetrate much more than the brick and mortars of a bank can.
Yeah.
I have here Mahendra, who heads digital banking for us, very efficiently coexisting with a brick and mortar 160 branches which I've got.
Wow.
The reason is, a bank signifies trust, but its branches can never deliver sufficient credit, as Sashank said, to the unpenetrated. Therefore, you need the partnerships. And partnerships are exactly with the fintechs of India. We are very happy at the moment. We are trying to tie up with about 30, 40 partnerships. And I think the number will plateau at multiple of that. Because every fintech brings on board domain knowledge, which a bank may or may not have, penetration capability, speed of access, and CAC, customer acquisition cost, which is much lower than a normal bank can afford. So in my view, like I said at the end of the last round, fintechs and banks are buddies, are best friends, they're besties. We have to exist and forge further ahead because we want to get India in 2029 to the third largest GDP in the world. And we have to do it together with the guardrails which the regulator sets for us. Noopur, would you like to add?
No, Inderjit, I think you made the point very strongly, and I would absolutely agree with it, that I don't see, rather I see banks and fintechs as two sides of the same coin. They have to coexist because one brings in the trust and a low-cost book, both of which are very important. The banks also bring on board the compliance DNA, which is required in today's day and age, so that the partner fintechs don't falter. So they bring in that oversight. However, what fintechs can bring in, I think it'll be some time before the traditional banks can actually move there, which is the agility and ability to serve the micro customers or come out with niche segments, which the vanilla products of the banks cannot, unfortunately, get into at this point of time. So, I mean, fintechs, by definition, have larger technology teams working on cost efficiencies, on going and creating solutions which are conducive for a certain use case. And banks with not more than 5–10% of their costs behind technology cannot do that in a hurry. So absolutely, they have to coexist, and the more partnerships, the better.
At your end, Ram, you obviously work with a lot of banks. So would love to understand some of the best practices of like building a symbiotic win-win partnership with banks.
Look, I think as Noopur and Inderjit said, right, I mean, ultimately for a bank, it has to be very clear why it wants a fintech on board. And for a fintech, it's very important to understand why the bank is important, like Noopur said, compliance and all the other things. And I think if the scope of that partnership is well laid out, it kind of tends to become very, very good. The moment the confusion is that you're just replacing a temporary gap in the bank's armor, maybe he doesn't have a certain kind of KYC that only you have, and then once he discovers it, he'll probably do it himself. I think those are the areas that where you will find a lot of fintech bank collaborations kind of going out. Second is, I think, in general, over 30 years that I've been now working with banks, the important thing is also for the banks to understand exactly what the fintech does. A lot of times it's a black box. And I think a lot of banks then figure out that there's a lot of work that they thought the fintechs were doing and it's actually not being done. Similarly, for the fintechs, I think the key thing to understand really from a bank's point of view is how important it is that they have to go through their quarterly and yearly audits of data and everything else, and that you have to participate in it even if you are not a regulated entity. So I think the best partnerships that I have seen is when the fintech believed that they were as regulated as the bank, and the bank believed that it had to be as innovative as a fintech.
Well said.
And then I think it really worked.
Yeah. So on the topic of fintech bank partnerships, one of the things that you mentioned about the gap at the bank's end being temporary or like a long-lasting gap, right? As a fintech founder, how can you end up identifying whether the gap is something that is worth building for the next decade, or is it something which the bank will eventually build and then you will be ousted? Yeah.
See, I don't think of it in terms of gaps. I think of it in terms of specialization.
Yeah.
Right? Ultimately, I think in India, we're all building on top of two very large and well-developed ecosystems. The first is DPI, which Noopur is leading, right? Which is the best in the world, literally. And we're all fortunate to be able to build on top of that. And the second is a very mature banking system that has stood the test of time, right? And that is the store of the nation's capital and is able to intermediate that capital in a fully compliant manner. The challenge for a fintech is how can you find niches where there is a return to specialization? Right? So for example, is there a specific type of consumer product? Is there a specific type of SME that's not well served? Can you build something bespoke for that segment and leverage both DPI as a platform and banks as partners to unlock access to finance to that segment?
Yeah.
And I think ultimately that is the win-win.
Yeah.
Right? Because you're never going to have the cost of capital or the scale of a bank.
Yeah.
Right? And ultimately we're all operating on top of DPI.
Yeah.
Right? So the more specialized the offering, the more likely there is that there is a durable role for a fintech to do that. And that role is always in partnership with a part of the public infrastructure as well as the banking system.
Absolutely.
I think, in general, my at least rule for working with banks is that if you're part of the revenue part of the bank, those partnerships are usually very durable. If you're part of the cost part of the bank, you will finally mature yourself into a technology pure player. Right? I mean, that's what I've seen play out there. I think there are definitely gaps, I think, not just a spectrum. And I think those gaps in India, especially if you look at private sector banks and all that, I would say that they are unlike the counterparts in the Western world, far, far more agile and far, far more innovative than we give them credit for.
Yeah.
Obviously, they operate at a very different scale, and therefore it's like tickling an elephant sometime. So I think from that perspective, there is always a tension in the relationship as to the standard thing, right? You have to learn to distribute faster than the incumbent learns to innovate.
Yeah.
I think you have to have that tension, which keeps everybody on their toes. But as I said, if you're on the revenue side, and if we both are working, like Sashank said, if you're specialized, like for example, you have a lot of people who focus on student loans, and there is a whole range of areas where people have built expertise on, and those are all adding revenue to the banks also. Then I think those relationships tend to be very durable. I think that's the secret that at least I have figured out.
Great. I think no discussion on lending can be complete without talking about collections. It is said that it's easier to give out money, obviously, and every lender knows that the real hard work is in getting the money back. And I would like to get some thoughts from the panel on how they see collections evolving, what are the big changes happening on the collections tech side. And I think that's a question that we should start with Noopur, because she and her organization are at the forefront of it. So we'd love to understand a bit more about the trends that you're seeing and how you see that evolving in 2024.
Yeah, sure. Thanks, Abhiroop, for that. You're right. Our entire journey around enabling EMI collections actually started during the COVID time. And it came as a demand from NBFCs to say that, hey, we are not able to send an agent across to collect. We are not able, the bank branches are closed, our branches are closed. How do I get my money back? And overnight, and I'm not kidding you here, in a month's time, we had 100 NBFCs coming onto BBPS platform to enable, or rather give the choice to the consumer, saying, irrespective of the app you use, the bank you use, the channel you use, you can repay back your EMIs, right? In lending, like we say that there are only two things which are important, the ability to pay and the intent to pay. As long as the customer has both of these, I think we should make it easy and hand the choice back to the consumer as to what is convenient for him to pay. Unfortunately, the way we have evolved, especially on the lending side, is historically we've been taking NACH mandate, which are only linked to a particular account, or we've evolved to e-NACH, but even then, there have been PDCs, again linked to a particular account. Now, what happens for me as a consumer if my salary now starts coming to another bank? How easy or difficult is it for me to go and change that mandate or replace those PDCs? I'm telling you, it's not easy at all. And therefore, what we are envisioning for lending collection, but also for other types of repayments and receivables, is an ability to democratize the mandate creation, cancellation, and resetting. So if I'm running a home loan with a particular bank, I can go to Google Pay, Phone Pay, or the works and tell that my home loan EMI was earlier getting collected from bank A, but I want to move to bank B or UPI or some other mode of payment as we move forward. So that's our really, North Star that we are working towards, to make it easy for the customer with ability and intent, and give him the choice to pay in cash, nearest Kirana store, and we have 1 million active agents who are collecting EMIs, utility payments, education fee payments, so on and so forth. But also all the digital interfaces, and there are 1,500 of them that we work with today. All of these should be available for these customers as well as SMEs to repay their credit back.
Thanks, Noopur. In addition to the usual collections which banking does, there are two factors which have come in helping us. One is customer awareness. You know, no customer in India wants to spoil their credit history anymore. Yeah. CIBIL score, rating agencies have suddenly become very powerful. You know, new to credit is one part, but existing credit, you better have a good score. You know, so India has evolved, and that has helped the middle tier collections incredibly. The second one, without taking much time, is digital collections. We have all heard of digital payments, digital onboarding. Now let's get to it. Digital collections is the next phase. We are using that. AI is helping us. And we know who is likely to default at what stage based on behavior of what they have done since they've drawn the loan down. It is helping us. And you know, I have young gentlemen here who helps me with my PRE and scorecards. They are a data analytics team, and they tell us how to digitally collect. So that, Abhiroop, is coming to India.
Great. Thanks a lot, everyone. We are almost out of time, but in case you have any quick thoughts, you can just share.
Two quick thoughts. One is, I think we are all benefiting from the fact that BBPS has been a game changer for collections. Right? I remember we just went live before COVID, and through that period, 99% of collections were digital. So thank you. Completely agree with Inderjit. I think digital collections is here to stay. We're already seeing AI powering digital collections. Almost 60% of our collections today is fully digital, right? And I think the other big piece learning for us is in-housing collections, right? Not seeing it as something to outsource, but actually building it as a strategic muscle. Which means your own tech stack, your own feet on street, your own telecallers, your own strategy and data science team that figures out how to prioritize, allocate, and optimize collections.
Yeah.
Once collections becomes a strategic muscle, it gives room to experiment, to innovate, because your goalkeeper is strong.
Absolutely.
And so I think you're going to see a lot more fintechs and NBFCs and banks actually talking a lot more about collections as an area of competitive advantage.
Yeah, absolutely. So I think
and it's not about stronger collections or bigger muscles, it's about smarter collections and faster muscles.
Yeah. And I think the key point to take away from what you said, Sashank, is that I think a lot of fintech lenders in particular underestimate that collections may not be a thing that they need to prioritize right now. But as a lender, I think that's the core muscle that you have to build. So instead of outsourcing that, it's better to build that capability, build that analytics in-house. And I think that's a lasting advantage in any lending business that can be built.